Hello, and welcome back to the Moss Adams Private Foundation Virtual Conference. We're pleased that you're able to join us. We have two presentations this afternoon totaling 2.5 CPE credits for this portion of today's conference. For the National Association of State Boards of Accountancy, to qualify for these credits, you must attend the one credit session for a minimum of 50 minutes and respond to at least 3 of the 4 polling questions. And for the second session offering 1.5 credits, you must attend for a minimum of 75 minutes and respond to at least 5 of the polling questions. Now, before we get started with the afternoon session, I am going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Welcome back for those of us that joined earlier today. I would say this morning, because many of us are in the Pacific time zone, but I know we have folks from several time zones, so I want to keep the morning and afternoon. We'll try to keep that out of my intros. We have a great session for you right after, again, Pacific Northwest or Pacific Standard Time, our lunchtime. We had some great sessions earlier today. With that, and in the interest of time, we're going to move right into that next session, Private Foundation Tax Deep Dive. We have 2 wonderful presenters lined up, Mike Lumsden, Moss Adams Tax Senior Manager, and Karl Mill, attorney with Mill Law Center. With that, I'm going to go ahead and turn it over to Mike and Karl to get us started.
All right, thank you, Wendy. It's a pleasure to be here with you all. My name is Mike Lumsden. I'm going to start off the tax presentation. As Wendy said, I'm a tax senior manager with over 14 years of experience in public accounting, and I've been a tax exempt specialist since day one. Also with me, Karl Mill. He'll take over later on in the presentation. I wanted to just chat about the agenda and the items that we're going to be hitting today. First and foremost, we're going to chat about donor advised funds and private foundation and the interplay that we often see with those two charitable vehicles, rather. Next, we'll chat about excess business holding rules. Thereafter, we'll chat about taxable expenditures beyond self-dealing. Thereafter, we'll chat about PRIs and MRIs and the differences between the two and how they're often used within private foundations. Next, jeopardizing investments. And last, clean energy credits. I know it's a hot topic for a lot of nonprofit orgs. So we'll chat about how private foundations can utilize those. All right. First and foremost, I wanted to chat about donor advised funds and private foundation interplay. So without further ado, we'll get going. First on the agenda, donor advised funds and how private foundations can utilize them as a part of their charitable giving plans. Now let's start with really what a basic definition of what a donor advised fund is. You'll see here a donor advised fund. It's essentially a restricted fund held by a 501c3 public charity. That would be, a 501c3 organization other than a private foundation. And it allows the donor or donor designees, and the donor designees, it could be an individual, it could be an organization like a private foundation. It allows them to provide advice to the sponsor as to the use of the funds, the investment of the funds, or both. So I really like to think of donor advised funds as really kind of like an intermediary for charitable giving. Now, private foundations and donor advised funds, they're among the most popular ways to give. Some statistics out there say that these two sources, they account for about 30% of all annual charitable contributions, so really a huge amount. And each vehicle does offer their own advantages and disadvantages. So I thought it would be helpful for us, for our understanding here, to highlight some of them here. Private foundations, owing to their high degree of control and flexibility, they're typically associated with larger scale gifts. But with that, of course, comes more complex rules and compliance requirements. A lot of us are aware of those and a lot of the hurdles that private foundations have to jump through. Conversely, donor advised funds, they're typically, but not always, thought to be better suited for smaller donors due to the relatively low cost of compliance. Typically, you'll see a small fee is paid to the sponsoring organization. And often there's a really simple setup involved with those donor advised funds. Additional advantages of donor advised funds are that DAFs are currently exempt from the net investment income tax, which private foundations incur. And they do offer better income tax deductions for individual donors. Typically, it's 60% of AGI for cash gifts and 30% of AGI for appreciated securities. Conversely, for private foundations, the deduction for individual donors, it's about 30% for AGI for cash gifts and 20% of AGI for appreciated securities. Lastly, a nice benefit of donor advised funds is that DAFs, they offer privacy. When grants go from a DAF, it's treated as a grant from the sponsoring organization rather than from the underlying donor. So it can often offer individuals and private foundations who do have to publicly disclose their grantees anonymity, that's a tough word to say, as all that is made available to the public on who the ultimate grantee is. It's made at the sponsoring organization level, and that sponsoring organization will aggregate all grants to the outside organizations, and thus the underlying donor is not named. There are some cons, though, to donor advised funds, which you'll see here on the right-hand slide. First and foremost, donor advised funds, they're under a lot of scrutiny right now. There's a lot of new existing proposed laws out there, which are really targeting donor advised funds. What IRS and Congress and watchdogs are concerned about are donor advised funds are really being used as a parking lot for charitable funds without actual being used to provide grants to outside organizations. I think there's a lot out there that says maybe that's not the case, but I think that's still the perception out there in terms of the general public. Also, we'll highlight later on in this presentation, you do give up a lot of ownership and control of the assets to the sponsoring organization when you do donate to a donor advised funds. I'm highlighting these two vehicles as often donor advised funds and private foundations. It's often thought of as a case of either or. Will I utilize a private foundation or a DAF for my grant-making activities? However, many grant-making private foundations can actually utilize donor advised funds in several ways to maximize flexibility and bandwidth. All right. Now let's get into the nuances of how a private foundation can contribute to a DAF and utilize it as a part of fulfilling its charitable purposes. We often see private foundations provide grants to donor advised funds in practice. Often the reason here is to assist in meeting their 5% payout rule. Most of us are aware that PFs, they're subject to special rules, including the requirement to pay out at least 5% of the fair market value of the assets each year for charitable grants or activities. However, there are often times when maybe foundations find it challenging to identify sufficient qualified grant opportunities in a timely fashion. And in these instances, rather than forcing a premature decision to satisfy the IRS rule, a private foundation might elect to grant part or all of its annual 5% requirement to a DAF. And that DAF currently isn't subject to an annual payout rule. By doing so, the foundation would satisfy the distribution requirement in time, while also giving those charged with grant making time to determine thoughtfully when and where you want to recommend those grants through the donor advised fund. There are also other reasons beyond the 5% payout rule for why a private foundation might want to give through a DAF as well. Some of these include, first and foremost, streamlining giving. What this will do is it pools resources with other donors, and it ensures charities receive maximum impact without excessive administrative burdens. So really here, we're looking at the benefit to the charitable grant recipients for ease of grant processing. If you're just going to be providing a $500 grant to one charity, sometimes that can be burdensome on that charity. Second, DAFs allow private foundations to leverage the economies of scale offered by the sponsoring organization of the donor advice fund, often for investment purposes. The sponsoring organization will often invest these funds, generate an investment return, and that can be utilized as a part of grant making. Thirdly, sometimes to donate internationally. We often find some smaller foundations, they don't have the resources to comply with the paperwork and due diligence requirements to provide international grants. And these larger sponsoring organizations of DAFs, they do have that expertise. And so you can, in essence, outsource these functions to that sponsoring organization. There are some rules to know though. If you do choose to give to a DAF, first, the sponsoring organization must be a public charity with 2 exceptions. You'll see these on the slide. The public charity cannot be what's called a non-functionally integrated Type 3 supporting organization. You can determine that by page 1 of Schedule A of the Form 990 of the sponsoring organization. Also, the sponsoring organization cannot either be a Type 1 or Type 2 supporting organization controlled by disqualified persons of the foundation. When private foundations do contribute to a DAF, it's crucial to understand here that you do give up a huge element of control. Instead, what you have now is what's called advisory privileges over how the funds within the DAF are utilized for grant making, and the sponsoring organization either can or can't listen to you. Typically, what we see in practice is that so long as the foundation isn't advising the sponsoring organization to run afoul of any laws or regulations, and the grantee organizations are typically in line with who the sponsoring organization would typically grant to, the sponsoring organization doesn't override the donor's wishes there. All right. Now, on the flip side, we often get questions from both our clients who are sponsoring organizations of DAFs, as well as our private foundation clients. Can a donor advice fund contribute to our foundation? In general, a DAF is not prohibited from contributing to a private foundation, but often the requirements are so burdensome that most sponsors of DAFs don't. Why is that? Typically, the rules for grants out of DAFs, they're very similar to rules for grants out of a private foundation. Like private foundations, grants to most non-public charities, including private non-operating foundations, individuals, for-profit organizations, typically you've got to exercise expenditure responsibility, or it's going to be a taxable expenditure. And really, few sponsors are really willing to exercise expenditure responsibility over these grants, as they're probably processing thousands of grants a year. The Internal Revenue Code, it imposes a 20% tax on the sponsoring organization if there's any grant out or a distribution out of the donor advice fund to any of these individuals or prohibited organizations. We do find in the space, though, that DAFs are willing to provide grants to private operating foundations, and these are typically foundations which are running some type of charitable program, and their main activities aren't grant making. All right. So in short here, currently there aren't any general obstacles for a private foundation and a donor advice fund to cooperate in grant making, so long as independence of action is both real and documented. And this really means that the sponsoring organization is not controlled by disqualified persons of the private foundation. A few things to remember as well is that this also isn't a workaround for individual grants. While a lot of times public charities can provide grants to individuals, distributions out of DAFs typically aren't allowed to be given directly to individuals. Also, one item that should be noted here is that DAFs also can be utilized by private foundations, not just for grant making, but also program-related investments. Typically, these are your low-interest loans for charitable purposes. These are rarer in instance, but still, you can get very creative with the use of DAFs beyond just grant making as well. All right. And the last item just to chat about with donor advice funds is it's an ever-changing landscape. As I mentioned, there's a lot of new rules and regulations which we think are potentially on the horizon. One of those is the impact that grants out of a donor advice fund would have on the ultimate public charity recipient. Currently, the rule is that if a sponsoring organization provides funds out of a DAF, For purposes of the ultimate grant recipient and their public support calculation, that is treated as coming from the sponsoring organization. Notice 2017-73, this is almost, 7 years old now. We feel like the boy who's cried wolf with this because we've been warning clients about this for 7 years, but there haven't been any real regulations about this, but we do think it could be coming along. This would treat the grant as coming from the underlying donor, so ultimately the private foundation. So here's a great example. Let's say for a public charity, their only source of support is, let's say, $1 million from a private foundation that went through a donor advised fund. Currently, the rule is that you would have 100% of public support because the grant from the donor advised fund, it's not limited in the public support calculation. These new rules would change that to consider the grant as coming from the private foundation. That contribution is now limited to 2% of total support. So the public support percentage for that public charity would now just be 2%, meaning they would not probably pass any public support tests or thresholds, and they would look more like a private foundation. So that's one rule, law, regulation, which we could see on the horizon. The other is regarding President Biden's budget proposals. These have been in what's called his Green Book proposals to Treasury the past few years. Some of these proposals include saying that any distributions out of a DAF, for it to count for the private foundation's qualifying distributions, it needs to leave the DAF by the end of the next tax year. Currently, once the funds go into the DAF, that's treated as a qualifying distribution for the private foundation. This would change that to say the funds need to leave the DAF by the end of the next tax year to be treated as a qualifying distribution to that private foundation. So a lot of opportunities, I think, for private foundations to utilize DAF within grant making and their charitable vehicles as well. And with that, we get to our first polling question. And I will pass it to Amy. I don't know if Amy's here, but I can read it. This says, my private foundation or those that I work with utilizes donor advised funds to assist with grant making. We'll open the poll right now. And one thing to note while the poll is being open is you do have to disclose if you do donate to a donor advised fund on your private foundation Form 990-PF. There's a question about that. So you do want to make sure that it is being properly disclosed if you do utilize donor advised funds. All right. I think most people have submitted. All right. And it looks like a little bit more than half of us do use donor advised funds as a part of our private foundation grant making processes. So yeah, again, a very popular vehicle. Just be aware of the ever-changing laws and regulations surrounding them. And with that, I will pass it to Karl.
Thanks so much, Mike. Appreciate it. Like they said at the top, I'm Karl Mill. I'm an attorney for nonprofits. I'm a tax attorney, which means I spend a lot of time advising foundations and donor advised fund sponsors and other charities on complicated rules. None more truly unpleasant than the excess business holding rules. And I think you'll appreciate that by the time I'm done talking to you. I am going to attempt to do this in about 12 minutes or so. You're not going to learn the excess business holding rules in 12 minutes. If the private foundation rules, which I kind of like lay out here all in one place, were a map, the excess business holdings would be where they put all like the dragons, the scary stuff. It's different. Like self-dealing is scary in its own way because people mess it up unintentionally. Excess business holdings problems are relatively rare, but they are the rules and regulations are much harder to untangle in my experience and harder to help clients understand what it is I'm talking about. A feeling you'll probably be able to relate to in about 10 minutes, but I promise to do my best. The basic rule you'll see there is, excess business holdings mean they can't hold more than 20% of an active trade or business. But like, if I really try to break that out, I'll start here. And so rather than spend a lot of time on what the excess business holdings taxes are, okay, it's 10% of the excess value of the business each year. And, we can talk about abatement and correction and second tier taxes and that sort of stuff. But I really just want to focus this 12 minutes on how do I sort of identify when I have an excess business holdings problem and when I don't? Because it's not intuitive. Like my little glib thing says, the basic rule is, the cap is that a foundation and disqualified persons can own an active trade or business only up to 20% in aggregate. So between both of them, the foundation and all disqualified persons anywhere, subject to exceptions and exceptions. Yeah, you get the joke, right? Like it goes on and on and on, no matter how many, for every rule, there's an exception, and for every exception, there's an exception. So let me just sort of start by like looking at these three scenarios I made up, and I put problem next to all of them. Does that mean that they're all excess business holdings? I don't know. I mean, we don't know. We don't have enough information because the rules are so complicated. It depends. What does it depend on? Well, what kind of businesses are they? I see in all of these things, the foundation, in the first example, the foundation and family own 80% together. In the second example, the foundation only owns 5, but the family owns 20. 25 is more than 20. The last example, the foundation owns 25 on its own. Surely you just told me a foundation can't own more than 20% of an active trader business. These are all excess business holdings. And my answer to that is maybe. Well, what kind of business is it? What kind of income does it generate? We'll talk about how certain kinds of businesses are treated as active trader businesses. Some are not. And this is a rule about active trader businesses. In scenarios 2 and 3, where we're above 20 but under 35%, I might be asking who the other owners are. Maybe there's an exception I can take advantage of there. In all of these, I might be asking how and when did the foundation acquire the interest? There's an exception we'll talk about that applies depending how it got the interest. Does that maybe buy us some time? For all of these, I'm just talking about percentages as though that means anything. We actually need to know percentages of what? Percentages of voting stock, of non-voting stock, of profits interest? Are we talking about an interest in a trust? Or what are we talking about here? That will also determine whether you have excess business holdings. So all of these are what I would call potential excess business holdings problem, and a reasonable goal for this 12 minutes is how can I spot a potential excess business holding problem and maybe get an idea of how to try to narrow it down. So let me give you another, let's go through the definitions first, and I'll give you another set of charts. Key concepts. So let's start with the first thing. What's a business holding? Let's break the word apart. Business holding is voting stock in a corporation or profits interest in a partnership in an active trade or business. We'll talk about trust another time. Voting stock or corporation, profits interest for a partnership in an active trade or business. Okay, so that leads to the next question. Well, this counts, and just to be clear, this counts both direct business holdings and indirect business holdings. What do I mean by that? Well, it applies to something that the foundation or a disqualified person owns itself, but it could also apply to something that the foundation owns. So my example would be, if the foundation owns a 50% interest in a passive company, like an investment fund, and that fund owns a 60% interest in an active company, the foundation is deemed to have a 30% interest in the active company, 50% times 60%. So now I'm not just dealing with the thing that the foundation owns, I'm dealing with the thing that the foundation owns, what it owns, and then maybe potentially the things that it owns, and et cetera, et cetera. And if you know one thing about investment funds is they just love to share you all the details about the things that they own, right? So like, it's a very hard question to answer sometimes when you're talking about what a foundation's business holdings are. What's an active trader business? This one is relatively self-explanatory. It's got to be something that's actively conducted as opposed to one that's passive. So, the key exception that we often point to here is the 95% passive income rule. If a business generates 95% or more passive income, that's your rent, royalties, interest, dividends, or gains, not an active trader business. That's good news when I have a foundation that says, oh, I think I have an excess business holding problem. We own 100% of this residential real estate empire. And I was, well, does your residential real estate spit out rent primarily, perhaps 95% or more? Yes. Okay, you're good. Introduce a thing where that empire decides to own some sort of thing that gets paid fees for services. Now I have an active trader business. So you got to really drill in and say, what kind of income is being generated? Does this exception apply? And the passive income exception being probably the most helpful exception that we have. What does the word excess mean? Well, excess means 20%, except when it doesn't mean 20%. It generally means 20% of anything the foundation owns and disqualified person. So family foundation owns 5%, parents, brothers, all on the board, and then their kids. Add up everything. Add up everything they got. If it's over 20%, we potentially have an excess business holding. One exception would be if I can keep the foundation below 2% in the company, then I don't need to worry about family ownership as long as you have 2% and less of vote or value. That voter value is important when you get in the weeds on this stuff. That is good enough that I don't have to add up the family. So one strategic thing I will sometimes deal with when I'm talking to a foundation, they're like, look, we just can't possibly figure out everything that every disqualified person owns. They own it through funds, they own it through other, we just don't know. And I would say, well, look, if you keep your foundation below 2%, then I don't need to ask that question. And so that can sometimes be a helpful strategy. There's this weird modifier. Like I said, it's 20% except when it's not 20%. There's a rule that says if the foundation does not effectively control the company and another non-disqualified person does have effective control of the company, then the limit is 35 instead of 20. So I gave you those two examples where the foundation and family came out to about 25%. And they might say, oh, no, I heard it was 35. It's not 20. We're fine. And then I'd have to say, okay, well, who else owns the company and who else controls it? If I can point to someone else as saying they control this company, not this family or foundation, then I can say, okay, we can apply the 35% number. I've seen people try to apply that rule to any time where there is a general partner in a limited partnership structure, because by definition, doesn't the manager or general partner always effectively control the partnership? None of this is legal advice, and definitely not this sentence. I don't know. It doesn't seem right to me. I think you really, what I have always interpreted that rule to mean, you got to point to someone else that is a bigger owner than you are that controls it. Like, we're not going to hold you guys. We'll let you guys be at 35% if there's someone else that's at 50 or 51, because then somehow that's different. That's just my interpretation. I think it's a complicated issue, but just, remember this, you don't get this 35% rule automatically. You got to prove that it applies. So this is incredibly complicated. I have a bunch of slides that are way more complicated and I'm going to mostly skip over, but I wanted to try, here's what my streamlined approach to thinking about excess business holdings is. When somebody gives me a chart like this, is I start by, okay, what are the businesses that I need to evaluate and what can I cross off the bat? And so if I look at this, I see 1, 2, 3, 4, 5 different potential businesses. I would say, let's start with top left. Let's go. Investment fund. I would say an investment fund is probably not an active trader business, but it owns some active trader businesses. So the fact that I have, if I add it up, 100% total ownership in the investment fund means it may not be an active trader business, but I still have to worry in case it owns an interest in one. A factory, I don't really know what a factory does or is, but it's probably active. I'm going to safely assume that the foundation owning a 60% of a factory and the family owning a 20% means that it's probably a high risk. Rental real estate, I gave you that as an example. If it's operated like most rental real estate, it's probably going to pass that 95% exception because it's probably going to be mostly rent, which is passive, or gain when you sell property, and that's passive. Note that for purposes of this rule, you might have unrelated business income because it's debt financed. That doesn't change the character of the income for this purpose. So you might be paying UBIT because you've got mortgage rental real estate. It doesn't make it an active trader business in and of itself. Drop down to the bottom. I have indirect interest. If I do my math, it looks like my foundation the foundation and family together own a 40% interest in the loan fund and an 80% interest in this tech company. Loan fund, I would argue maybe that's passive. Maybe that's mostly interest it's generating. Maybe I don't have to worry about that one. The tech company sounds active. I don't know what tech companies do either, but they presumably sell things, and selling things is an active trader business. It's my very sophisticated way to try to narrow it down to what I'm probably worried about right now are the factory and the tech company out of these 5 pictures. What percentage holdings are we at? Well, let's start with the factory. 80 more than 20, also more than 35. So don't ask that question. Doesn't work, right? What am I at in the tech company? Well, if I measure the family, the foundation, the family together, I appear to be at 8%, and 8% is less than 20. Though I suppose I should be asking the family members whether they have any other interest in that tech company. How do I know that they don't have some direct interest in that tech company? That's where I point you back to that 2% rule. And I made these percentages very intentionally. What is the foundation's deemed interest in that tech company? 25% times 8%. 25% times 8% is 2%. I can use that 2% rule, hopefully, to cross out that 10 company if I only have 2% of the voter value. I hope this exercise gave you an impression of just how fun excess business holdings rules can be. It involves math, it involves exceptions. I also need to ask myself, do I need to worry about the 35% rule here? Probably not helpful for any of these. The only other thing I might ask would be, are there any other exceptions we can rely on? I'm still stuck with this factory. Is the factory a problem? Probably the most common one that foundations think about is the 5-year exception. If a excess business holding is received by gift of request, you have 5 years to dispose of it, or another way of saying that is get below the 20 or 35% number as applicable. You can theoretically extend to 10 years with IRS permission. So that's a big exception. So if that factory was donated and the foundation's still trying to figure out how to get rid of it, 60%, maybe that's a path to not having an excess business holding. So anything else on this one I want to cover? Newman's Own exception, let's not even talk about it. It doesn't apply here because none of these are 100% ownership. Functionally related business, I didn't describe anything that sounded all that charitable, but I'll briefly cover what that exception is. I'm going to kind of just give you this whole slide and tell you what I want to talk about, because I don't want to spend all the time talking about excess business holding, as much as I'm sure you all would love to do that. Very commonly, the question that funders will ask is, can I leave my entirety of my business to a foundation? And the answer is it's kind of complicated. And if it's just a straight foundation, it's probably going to be hard. We can ask about the kind of business it is. Is it really an active family business? Can we, the 5-year exception buys us time, but doesn't solve our problem. There's a thing called the Newman's Own exception. You'll have a slide on that you'll be able to look at later, and you'll find that if it applies to any of your clients, I'm very surprised. A functionally related business is something that is sufficiently charitable. I'll talk about in a second. Can you restructure the business? Perhaps. Can use different kind of entity. This is not a talk about C4s as foundational alternatives, but if it was, I would tell you that is exactly what a lot of the C4 planning going into is, that C4s are not subject to excess business holding rules and have made for Patagonia and others a very nice place to send a lot of family businesses to. So that is sort of my version of this conversation when people ask me that question. It's not really new anymore. Time has passed. The reason no one uses this exception, I'm just going to sum it up by saying no one uses this exception because it requires a degree of independence at the business level from the family. Basically, total independence from the family member of the funder of the foundation. Not usually how family businesses work, right? Usually they're there because they want the family to keep working there. Or at least be on the board, or at least be a contractor. Can't do any of that. If that doesn't kill it, the next one might, because it's basically saying a majority of the board can't be directors or officers or family members of the substantial contributor. So I need a board that is mostly not the family of the contributor. That's, again, not how family foundations work. So this is a tough one for family foundations. I've had 1 or 2 times where I've gotten pretty far down the road with it, but never actually put it into place in the whatever number of years since it was passed. Very briefly, helpful exception. I'm going to talk about program-related investments shortly, but functionally related business is kind of a middle category. So one way for a business to be functionally related and exempt from excess business holdings is to be a related activity. So it's actually like I gave examples of for-profit schools or health clinics, things that are actually doing charitable educational work that are sufficient. That is a way that if you are a functionally related business, you're not subject to the excess business holding rule. So a foundation could own 100% of a Delancey Street-like operation where charitable and educational programming is built into the business work, sufficiently to make it charitable, or it's a school or a clinic. Those could be good enough. The other is probably maybe a more common use of this category, which is like the business isn't a charitable activity, but it's tangled up in one. Tangled up in one is a very technical term. What I mean by that is, you go to the museum, Family Foundation Museum, the Broad, whatever you want, Getty, and you go there and there's a gift shop running there, or there's a restaurant there, and the foundation owns 100% of it. A restaurant is an active trade or business. Excess business holding. And you say, no, this is a functionally related business. No, the restaurant itself is not charitable. We're not teaching people how to cook here, though plenty of people have tried that one. We are just so tied up in the museum operations, which is a charitable activity, that we should be allowed to own the whole thing. So those are the ways that category gets used. I'm not going to do the restructuring one. Check those slides if you want to check it. That was way too ambitious to try to put in here. Just know that the excess business holding rules and the definitions around voting stock are eminently gameable, and people may play games, and there are ways to use the trust to get out of some of these rules. I gave you the example of a PLR that does that. Interesting questions, no time to talk about today. I'll hand you off to the polling question.
All right, thank you. So the second polling question is, a private foundation owns 5% of a C Corp operating an active trade or business. Additionally, the board chair and substantial contributor to the foundation owns another 20% interest of the same C Corp. Is this permissible under the excess business holding rule under section 4943? And then quick answers, A, yes, or B, no. And then while you're selecting that, I do want to remind you that for this session, you do need to respond to at least 3 of the 4 polling questions to get CPE. All right, here are the results.
All right.
I think I agree with that. Of course, the nuanced answer is always it depends. We could have come up, you could have said counter, someone else controls most of this, so 35% is the cap. But I think the answer we're going for is 5% plus 20 is 25%. I told you it's an active trader business. That generally means it's going to not be permissible under the excess business holding rule. So no is maybe the more correct answer, though it depends is always the only real answer that ever counts.
It's always it depends, right? All right. Moving on. Next, I wanted to touch more on taxable expenditures for private foundations under Section 4945D. We've already heard about taxable expenditures for PFs carrying on propaganda, influencing legislation, or influencing election, which I know is, of course, a very current hot topic of the moment. I wanted to take some time to touch on other elements of 4945D, which sometimes do get tripped up by private foundations. And you'll see those 3 highlighted in light green at the bottom of the slide here. What we'll cover is grants to individuals for travel, study, or other similar purposes, and when they would be a taxable expenditure. Grants to organizations other than a public charity or exempt operating foundation, and when those would be considered a taxable expenditure. And expenditures for carrying out a non-charitable purpose, when those would be considered a taxable expenditure. All right, first let's cover what individual grants are and aren't. Individual grants, those include grants to individuals for travel, study, or similar purposes. And really, it's crucial to understand that it need not matter what it's called. It could be called a scholarship. It could be called a fellowship. It could be called a prize or an award. It really boils down to the nature of the assistance in determining whether it's an individual grant. I often say if the purpose of the assistance is not to benefit the foundation directly, meaning the foundation is not the benefactor of any services in exchange for the outlay of money. And you can see that listed in the exclude section at the bottom here. It likely is considered an individual grant. There is one exception to when foundations can provide an individual grant without it being considered a taxable expenditure. And you'll see that in the last bullet point. Foundations are allowed to provide awards for past achievement. I think a great example out there is the MacArthur Foundation. They award annually the MacArthur Fellows. Awards like these, they'll often help establish the importance and legitimacy of a field, and they'll often also compel individuals beyond the recipients to pursue, creative activities or passion projects as well. Foundations, though, they should still be cognizant of the IRS rules when designing these award programs. Those rules are: the award cannot be tied to future travel or study, and the foundation also must be really careful not to impose restrictions on how recipients should use the awards. Typically, we often see no strings included with the awards language right there. All right, now let's chat about grants to intermediary organizations who then might use those funds for individual grant making. Would that be okay? Again, our favorite answer here is, of course, it depends. It depends on really a single factor, and that's called earmarking. In general, a foundation can grant to an intermediate organization so long as the foundation does not earmark the grant for a specific named individual, and there is no oral or written arrangement to designate specific individual recipients. In these instances, the individual grant would not be attributed to the private foundation, but rather would be attributed to the intermediary org, and thus would not fall under the Section 4945 taxable expenditure rules. Ultimately, with these types of arrangements, what you want to ensure is that the intermediary org controls the grant selection process and makes the decisions independently of the foundation. So really, the foundation shouldn't have representatives sit on a grant selection committee of the intermediary org. Also, the recipients of the awards, they really should not be individuals somehow connected to the private foundations. So here, no family members or related persons of insiders of the private foundations. That could trip up self-dealing rules as well. All right. There are some instances, however, in which it would be okay for a private foundation to provide individual grants beyond awards for past achievements, which I know we highlighted 2 slides before, and have it not be considered a taxable expenditure. Grants to individuals, they're permissible if utilized for travel, study, or some other similar purpose under 2 criteria. 1, the individual grant is awarded on an objective and non-discriminatory basis. Here, what you want to establish is that the group which the grantees are selected, they're reasonably related to the purposes of the grant, and the group must be large enough to constitute a charitable class. Also, you want to make sure that the criteria used in selecting grant recipients, that it's somehow related to the purpose of the grant. So, for example, a proper criteria for selecting scholarship recipients might be past academic performance, results on tests, etc. Lastly, the person who selects the recipients, again, they should not be in a position to receive a private benefit. So you want to make sure that it's not going into any insiders right there as well. So also what you want to make sure is that these procedures are approved in advance by the IRS. A lot of times this is done on Form 1023, and we're seeing a lot of 1023s just a blanket selecting, yes, we're going to provide individual grants, even if you're considering it, but you're not sure. It might be prudent to select that because that will give you greater flexibility to provide those individual grants later on. If you didn't select yes on your Form 1023, you can do so on Form 8940, the miscellaneous determinations filing. That's got to be done online now. And the IRS really does want to see your procedures here. Once those get approved, you can do those individual grants for travel, study, or a similar purpose. All right, some questions come up. Let's say we provide a grant to an LLC. Is this considered a grant to an individual or to a corporation? And really, it depends. You know, what you want to look to is the LLC, is the sole member of that LLC, is it an individual? If so, and it's disregarded for tax purposes, that's likely considered a grant to an individual. So with that, we want to assess the purpose of that grant or that loan. Is it for an award for past achievement? If so, it's likely okay. Or is it for a travel or study or travel or some other study purpose right there? If so, you want to make sure that you've had that pre-approval with the IRS. Also, you want to identify potential sub-grantees and secondary recipients. Again, this is that intermediary org rules right there. If you're providing it to a corporation who's then granting those out to individuals, you want to make sure that you don't designate those individuals and earmark those grants for individuals, because that would be considered ultimately your individual grants right there. Lastly, if you're granting to an LLC and it's considered a corporation for tax purposes, you of course want to treat it as a grant to an organization and exercise expenditure responsibility over that grant. All right. I think a lot of us know these rules right here. Grants to the following recipients, they're not considered taxable expenditures. Publicly supported charities, including DAFs, supporting orgs, except for non-functionally type 3 supporting orgs. Exempt operating foundations, those are okay. State schools, foreign government agencies, and international orgs. You don't have to do anything for grants to these. They're kind of blanket okay. However, if you do grant to any other type of organization, of course, you would want to exercise expenditure responsibility over those grants. A lot of us are probably very aware of what expenditure responsibility entails. First and foremost, you would want to do a pre-grant inquiry, which is essentially ensuring that you're getting reasonable assurance that the grantee will use the funds for proper purposes. Kind of probe management, see what's out there that's made publicly available to ensure there's no red flags, and document that. Next, you want to make sure that there's a written grant agreement, and that's got to include the specific purpose of the project and the grant funds, as well as a clause in there that says the funds are only to be used for that purpose, and that also the grantee is going to submit reports to the grantor as well. Of course, you'll want to receive grant reports. Typically, these are received annually. And then you'll also want to report on this on your Form 990-PF. And if you trip up any of these, it could be ultimately a taxable expenditure. So you want to make sure that for these grants to organizations, you are following all of these rules as well. All right. Grants to organizations. Can we provide a grant to another private foundation? Grants to private non-operating foundations, these require expenditure responsibility, which we covered before, but then you want to make sure that you're complying with the out-of-corpus rules. What this essentially entails is that the grant out from your foundation can't be double counted as a qualifying distribution to that ultimately second private foundation. So you can't double dip on that grant amount right there as well. All right. Grants to organizations, foreign equivalents. This is the last section we'll touch on in this section. Typically, these are okay, so long as it's a foreign equivalent U.S. public charity. How can we determine that, though? You need to get a good faith determination on a current written advice from a qualified tax practitioner. You might think that might be us. I think the best place for this, though, is NGO Source. This was established in 2013. I think that says 2013, to really streamline equivalency determinations and reduce costs. Typically, they've got a bank of pre-vetted charities, which they determined are foreign public charity equivalents. If it's a new one that's not in their system, you might have to pay a little bit more, but you want to make sure that the date on that equivalency determination, that it does cover your grant period as well. All right. And with that, we'll get to our third polling question.
All right, so the third question is, my private foundation or those that I work with have filed a Form 4720 for a taxable expenditure for a grant to a non-U.S. public charity where either expenditure responsibility wasn't exercised or an equivalency determination wasn't obtained. And then A, yes, or B, no.
Yeah, sometimes lately we've seen a little uptick in these, I think, just because a lot of these rules are very, very complicated sometimes. And you might think maybe the grantee is okay, but you want to make sure that you do proper due diligence on all of these.
All right, we're going to close this in 5 seconds. Last chance to select a response and hit submit. All right, here you go.
All right, it looks like about a third of us have. So yeah, it's common. You just want to make sure that you correct those procedures going forward if you happen to have those sometimes. So, all right. And with that, I'll pass it to Karl.
Thanks, Mike. And I will say, just as a general point, this is the non-self-dealing portion of the foundation rules. Helpful reminder that for those folks who filed 4720 before these are the categories where it is possible to seek abatement, jeopardizing investments, taxable expenditures. These are all areas where one could. Self-dealing, you can't, and there's no good faith, reasonable cause exception to try to pass through, but you can for this. And that includes jeopardizing investments. This is a very important topic that I've taken not very seriously with these pictures, but I will say, like, I did it this way because it's really hard to talk about jeopardizing investments, because I can't think of a time where I've talked about the rule a lot, and I generally speaking talk about it as a prudent investor rule, right? This is the IRS has a rule that effectively enforces the prudent investor rule that applies under most state laws against foundations, requiring them to invest prudently and not in a manner that jeopardizes their charitable purposes. But it's very hard to ever get anyone to corner down and say which of these things is a jeopardizing investment. We'll talk about what little guidance we have. Here's like the things I can confidently say. Like if you are making an investment that you know is going to lose money, that's a jeopardizing investment. Like it's the setting money on fire example in my AI artwork, that's losing money. Making an absurd bet of all the foundation's assets, that would be a jeopardizing investment. Everything else is a real look at the facts and circumstances kind of situation. It's about the portfolio as a whole, not a particular asset that's important. But I do think you can take a lot from a MIFA, which I'll talk about in a second, as a way of sort of, providing guidance. I actually went back to the Treasury regulations, and, each day I know less and less what Treasury regulations mean from a legal perspective, but I do know that they are very helpful when interpreting these rules. So I went back to see, does that Treasury actually touch on it? Because I was assuming they would, and they try to do. They give us two examples. They talk about a foundation investing 10% of foundation assets and promising product loses money and widely reported as undercapitalized. And another one is 8% of foundation assets and things going poorly, right? Higher risk investment by most investment advisory services with little prospect for return. But at the end of the day, all the regs say are these maybe jeopardizing investments. Even in our examples, we can't get them to commit to an actual position on whether an investment is jeopardizing because it's so subjective, right? There's a prudent investment rule, portfolio as a whole. One thing that I did think was interesting about these two examples, sometimes when I tell people, oh, well, you can't make a jeopardizing investment, they say, what's that? That's an investment that jeopardizes your charitable purposes. They say, when, if it's 20%, of my portfolio, that can't be jeopardizing. I still have the other 80%. And like, no, that's not it. It's actually acting as a prudent investor. So the fact that they gave examples when we're talking about 10% or 8% is at least a reminder that, according to Treasury, it's not about betting the whole farm. It's about making imprudent investments, right? So I thought that was helpful and interesting. But the real thing, and then these are examples, some of which come from the regs, like problematic asset types potentially. You could probably toss in other more modern things on there, like crypto maybe could be on there. But again, even the regs are saying none of these are bad per se. There's no quote unquote bad asset to invest in. What there is a need to have a portfolio that reflects a risk adjusted return the way a prudent investor would act, and with diversification, right? Like that's important. In 49 out of 50 states, including the state I practice in, California, my basic advice is look at a MIFA. A MIFA is the prudent investor rule in 49 out of 50 states. It tells us these factors we're supposed to consider. It requires diversification. All of these factors are unless otherwise provided by a gift instrument. So there is flexibility if you plan ahead. Helpful reminder that rule exists for folks who have a founder that wants their company they want to hold that publicly traded stock as 20, 30, 40, 50% of the portfolio. From a pure legal perspective, your ability to justify that could be helped by a gift agreement. But without that gift agreement, MIFA applies under state law. Consider all these things. In general, bad to bet the farm on one stock. But yeah, same basic principle. So for me, there's not usually a big gap between when I'm talking about a MIFA and when I'm talking about jeopardizing investments. I'm talking about the same basic set of rules. Like a MIFA, I'll cover that in a second. These are the taxes that apply. I have never actually been in a position where I've seen someone self-report a jeopardizing investment because it is so subjective. In the cases where I've seen the IRS assess it, I believe it's always in the case of some overly abusive thing. And it's like on top of everything else, we're going to throw this on top of it too. I have never seen anyone say, hey, Karl, your investment portfolio is imprudent. We're summing up and assessing this one-off tax, or me, your accountant, or me, your lawyer have to tell you definitively that business because it's so subjective. But this is what would happen. These are the taxes that would apply. They're actually quite steep if you do the math of 10% of your investment, and very much feels like an insult to injury. Like you've probably invested your money in this asset, lost a whole bunch of it, and now it's by the IRS. We're going to come take 10% more because you did such a bad job investing, right? So it's an interesting tax. Remember, this is imposed on the foundation unless it's the foundation manager, and if there are clients on the phone, earmuffs. I mean, the thing about the foundation manager tax is like the legal standard for applying it is very high. It's very, very rare that I would ever take the position that foundation manager tax applies to that knowingly, willfully, without reasonable cause standard. But as an advisor, it is extremely helpful to emphasize that it exists, to get people to pay attention to the rules, because people hear that they could personally be liable, and that means a bit more. Even if you read the fine print, the odds of them being personally liable are pretty low. That's a general point about a bunch of these rules is, focus on the foundation manager taxes, but when push comes to shove, we'll usually push against them applying. Oh, interesting jeopardizing investment exceptions. One is about PRIs, which I'll talk about very, very briefly in 1 minute. It doesn't apply to investments acquired as a result of reorganization. Like if you were kind of forced into it, you can't help it. Another piece of AI artwork that I've always found strange is the jeopardizing investment rules do not apply to assets received by gift. So I think this was me saying donor handing foundation a dumpster fire, right? And it's like, is that a jeopardizing investment? Well, I guess it can't be because it's a gift, right? I would still call it an MIFA problem to not be diversifying from that because it doesn't seem like a great investment. But purely this is a pretty big exception when you think about it. If you're donated a weak or high risk investment, there's not a tax threat for you to diversify, but maybe there is a corporate law under MIFA, state law check on that. I will say that jeopardizing investments do apply to MRIs. I'm going to talk about mission-related investments, but Treasury told us in Notice 2015-62 that it's cool. You should feel free to make them. That's actually quite aligned with MIFA. Both at MIFA and in that notice, Treasury are telling us when a charity makes investments, it can consider mission as a positive factor. If it's a mission-related investment, it's still an investment. In fact, I will do all of my PRI and MRI slides. They're all here. I hope you find these helpful. But to me, this chart explains everything to me. And to most people, that's stupid. That chart doesn't make any sense. But to me, this chart explains everything about PRIs and MRIs, right? So what is an MRI? It is an investment where there is some consideration of impact. So the more impact I have, then I can maybe tolerate a little bit lower of a return, take on a little bit more risk and make an investment that maybe I wouldn't make if I were purely profit motivated. But it doesn't let me go off and make bad investments. It doesn't let me go and make investments that are clearly a threat. So it's not, so to be clear, MRIs are not an exception from the jeopardizing investment rule. It just reflects the fact that, yeah, you can take account and mission alongside return, but it's still on the whole got to be a prudent portfolio. So it's got to be close to the pass line for a normal investment, even if it's maybe a little bit under. PRI, I'll go back to the slide just because I should tell you the technical prongs for 1 second. 3 prongs. Primary purpose that furthers the foundation's exempt purpose. That means it significantly furthers charitable purposes, and they would not have made this investment but for those charitable purposes. The production of income is not a significant purpose, so it should be a concessionary investment or a bad investment. People don't like when I say that, but it should be it's actually supposed to be an improved investment. That's why it's an exception from MIFA. That's why it's an exception from the jeopardizing investment rules. It's not supposed to be a good investment. And you need to prohibit electioneering or lobbying. There's certain rules that go when you apply it to a non-charitable organization. You'll see I put PRIs in that bottom right corner because the impact needs to be high and the return can't be too high, at least for a foundation. Like I said, to me, this chart makes total sense. Most people do not agree with me. But that's sort of how I categorize it. And I often have clients that are trying to sell me on investments that are right in the middle that would kind of fall in the red. It's like pretty charitable, but not totally charitable, pretty weak returns, but not so weak as to justify a PRI. In any case, key takeaways for PRI, just to remember, they count as charitable distributions when you make them. They kind of unwind that distribution when you receive income, when they are returned, but they do count. They're a way of satisfying your minimum distribution requirement. They are not jeopardizing investments. They are not counted towards your 5% test. They come out of the denominator. And those are the 3 big ones. I would also say more or less, if you pass the PRI test, you're probably passing the relatedness for UBI tests, and therefore you're probably not paying tax on the income. Sorry, Mike, for leaving you only second for the poll and for clean energy credits.
We'll do our last poll, and while the last poll is open, And Amy, go ahead and open the poll. I'll chat about clean energy credits in the last minute or two that we have. As a part of the Inflation Reduction Act, there's a lot of clean energy credits available to nonprofits. This is really going to be applicable to foundations who have some type of physical building, probably. So do you own your building? If you're like you, leasing property, maybe not applicable to you, but there's clean energy credits available. The most popular one that we've seen is solar panels. Let's say you install solar panels on property that you own. You have to take the credit the year it's placed in service, and typically it's 30% of the credit of the construction cost, so long as the project is under 1 megawatt. That's about 5 acres of solar panels. With that, you did get about a 30% credit. So using an example of a $500,000 solar panel project, you're looking at a $150,000 refundable credit that has to be placed, or that has to be claimed on your 990T. That is timely filed. This is all new as of December 31st, 2022. We won't have time for the last 2 or 3 slides which cover that, but this is in your materials. So I'll let you know that if you're curious about that, contact one of us, just because it's a credit that you don't want to lose. All right. And that covers our presentation right on the hour. So we appreciate everyone's time, and there's likely questions in the chat that I know we probably didn't get to, but we'll make sure to follow up with everyone within a reasonable time.
All right. Well, thank you both for a great presentation today. We really appreciate it. And to our audience, we are going to take a quick break and then regroup for the final session for today. So please keep your webcast console open, and then join us back here at 2:10 Pacific time. So in about 10 minutes. Thank you.
Thank you.
right. Well, I hope everyone enjoyed the break and has enjoyed the sessions today. We are rolling into our final session, complex gifts and investments. And our goal, our aim is to equip you with a solid understanding of the accounting and tax implications of these gifts, providing you with the tools to effectively manage these complexities. Leading today's discussion are Moss Adams partners Elizabeth Dollar, Liz Dollar, an audit partner, and Lauren Haverlock, a tax partner and leader of our tax-exempt services group. I will turn it over to you, Liz and Lauren.
Thank you, Wendy, and thank you everyone for being here with us today. This last session of the day, I hope you've enjoyed what you've heard so far, and looking forward to walking through complex gifts and investments. As Wendy said, it's Lauren and myself on the audit side, and Lauren is the tax side, so we'll give you both perspectives on these gifts today. Please feel free to use the Q&A feature. We would love to have some questions and make this a little more interactive if we can today. So we will stop and answer your questions as we go along, and we'll also try to leave some time for questions at the end as well. So overview of today's presentation. We're just going to kind of talk a little bit high level about what complex gifts and investments are, some processes and policies that you may want to consider if you don't already have in place surrounding these types of gifts. A lot of tax information, Lauren, on what you get out of the donor's intent and the deduction, what you do with the asset, and then what happens when you do get rid of it, or if you keep it. So we'll talk about that from both the tax, regulatory, and audit, financial reporting perspectives as well. So Amy, it looks like our first polling question.
All right, so the first one is, how often do you receive complex gifts or investments? And your options are A, happens all the time, B, at least a few a year, C, once in a while, or D, never, but want to be prepared. And then just a reminder for this session, for CPE, you will need to respond to at least 5 of the 6 polling questions that we pull up throughout the presentation.
All right, let's be interesting to see if we have experts here or just want to learn more.
All right, 5 more seconds. Make sure to hit that submit button so that it registers for your CPE. And here are the results.
All right, kind of a nice split there. So I think, not surprised that it's once in a while or never, but, want to be prepared. And I think that's what will give you some insight on things to consider when you're looking at complex gifts and potentially receiving them. So what is a complex gift? I think technically the definition is a contribution of anything other than cash and or publicly traded securities, really the basic gifts. But I think, there's a lot of different things that can make a gift complex. We have some examples here of, things like real estate, personal property that might be more complex than just cash because you have to value them. Also then alternative investments, which we'll talk through quite a bit today on, what's an alternative investment and why is it a little more complex, closely held stock. But I think, as many of you haven't received complex gifts, just the fact that, you might receive something different, I think makes it complex. You don't know what you don't know, and there may be other reporting requirements you haven't considered. So I think this hopefully will give you a good overview of that. Lauren, you want to take us through some of the complexities on the tax side?
Yeah, and I'll talk a little bit on the tax side as we go to the next slide. Really, yes. And can you hear me okay? I'm kind of having a little bit of a delay, so I want to make sure everyone can hear me. All right.
Yeah, it's a little bit
Yep.
delayed, so we'll just work with that.
Liz, I'm not sure if you hear. Okay, well, not hearing anything. All right. Well, I can call in when it's no longer my time, but so the reason on the tax side that complex gifts are really valuable is because a complex gift. Okay, so I'm a little in and out. So I can let Liz take this all in and call in just a second. Sorry, we did a tech check and everything sounded good not too long ago. So I'm not sure what's causing the issue on my end, but I can call in via phone if that's going to work better on
I think
here.
you're working. I can hear
team.
you well right now. I don't know if you can hear me, but maybe you should call in.
Yeah, I think just a little bit of a delay. Okay, I'm going to call in. So Liz, why don't we hop back to my section and you can take on your section as I call in just to make sure that my number sounds okay.
Yep, no problem. I think, from this perspective, and Lauren can talk more about this when she gets back, but depending on what type of entity you are, there's definitely different considerations on how to report the gift and what the complexities will be. So I know we have a lot of foundations on here. There are also different rules for public charities, whether you're a private operating foundation. So there's different rules that Lauren will go into more on the tax side about the reporting requirements for each of these types of entities. And depending on what type of gift you get, there's definitely going to be some different complexities based on what type of entity you are. So we'll talk about that as we go through this as well. Also, different tax considerations on the type of property that's donated. Lots of different types listed here, but every time you get a different type of property, there's going to be different tax rules and deductions related to those various types for you as an organization and for the entity or for the donor who is giving the gift. On the asset types for GAAP differences, the reporting requirements are different based on different types of assets you're holding. And if you sell it immediately versus if you decide to hold a gift for, whether it be property, some sort of alternative investment, there's different rules around how you report those. Obviously, when you first get the gift, you're going to record that at fair value. But then subsequent valuation becomes the issue. Is it recurring fair value? Is it some type of intangible asset where you're looking at impairment analysis every year? Is a property where you're depreciating or amortizing the asset as necessary? So there are different types of things to consider from a GAAP reporting standpoint, as well as the tax differences.
And Liz, I can hop in a little bit if I sound okay there. Is that much better? Okay. Well, I'm not going to have anyone see. I did all my makeup for nothing, apparently, but I'm not going to mess with that delay there. So I do want to hop in and talk about how important complex gifts are from a tax perspective, because it does allow an organization and a donor to receive significant benefits. And so the reason that, when Liz showed those different entities and different considerations is that when a donor gives a complex asset to a public charity, and even in certain times private foundations, but mostly public charities, including donor-advised funds and other types of community foundations, they're allowed fair market value deductions for their charitable contribution. And they don't have to account for those capital gains and the gains that are connected to their contributions as income. So they kind of get this double benefit. It's a little more complex than that when you dig down into what the donor's deduction is, because there's other factors to take into account. But really that provides such a huge benefit to a donor to be able to take that large donation and to be able to not realize those capital gains, that it's something that's a really powerful way for a complex asset to benefit both donor and tax-exempt organization at the same time.
I listed out, in one of those previous slides, the different types of assets and how they're broken down from a tax perspective. It's a little different when you're looking at what you're recording from a GAAP perspective and what the considerations are from a tax perspective when you're looking at filing a 990 DPF or 990, and when the donor's looking at their charitable deduction. Each of those different elements of those properties have different characteristics that factor into a deduction. So when a donor says, hey, do I get a fair market value deduction for this item if I'm giving it to you? First of all, as a nonprofit, you probably shouldn't provide tax advice, but the answer is always going to be it depends. It depends on their basis. It depends on the appreciation. It depends on, some of the different types of deductions taken in the course of that asset. But those are the different categories that are most relevant from a tax perspective. So sorry, back to you on the GAAP side, Liz. Sorry about that.
No problem. Yeah, we can hear you much better now. So, I think we have a lot of content in this presentation on alternative investments because oftentimes that is something that a donor is wanting to gift, and it may be in the form of different types of investments than just your marketable securities. So it's not specifically defined in GAAP an alternative investment, but it is something that's not your ordinary stocks and bonds. So we've listed here some of the things that are most commonly seen. The hedge funds, private equity funds, real estate funds, venture capital funds, fund of funds. These are they can be various types of legal structures, partnerships, corporations. So then that's where the complexity comes in, not only on the reporting side, as many of you may know, if you have an audit, there's a lot of things we'll go through. You have to consider from an alternative investments standpoint, but also from a tax perspective. And if you have to report differently on those various types of investments, or if there's foreign requirements. We'll go into a lot of that, but just wanted to kind of set the stage because the alternative investments are definitely a big part of the complex gifts and kind of a unique gift as well. From an audit perspective, this is what the auditor hat in me thinks about, but also, should consider as management when you get these types of gifts, is really what assertions are we looking at? And it's existence and valuation. A lot of these things, cryptocurrency, you can't, the whole thing is that it's anonymous. There is no way to hold this token that you apparently have. So how do we know it really exists, that you own that, because you can't physically hold it? So that's something that, is a risk area and you need to consider, as well as valuation. A lot of these things are not readily available values. There's no trading market. So how do you obtain those values? If there's is there recent data? Are there audited financial statements? So those are a lot of the things that you have to consider when looking at alternative investments. We also have the fair value hierarchy here. So if you have GAAP reporting requirements, I'm sure you've seen this, but they typically, the alternative investments fall into this level 3, or use net asset value as a practical expedient. But you have unobservable inputs in there. So it's not based on the quoted market prices, or some of the bonds have, a valuation technique that's level 2, but level 3 is typically where you see these alternative investments from a GAAP perspective. Looks like we have our second polling question. Amy?
All right, thank you. The second poll is, do you have a formal gift acceptance policy? And your options are A, yes, B, no, or C, maybe.
I'm interested to see. Policy is always good. I think that, as we'll talk about in just a second, a policy is only as good as the process that everyone has to make sure that they're following the policy. So to see what everyone says here.
All right. Well, that's good. Over half of you have a formal gift acceptance policy. Those that don't, there may be good reasons for that, and maybe is good to get you thinking, and maybe ask the questions to see if you do. So we'll talk a little bit about gift acceptance policies. I think it's good to consider and ask the question. There's several different reasons, I think, to have a gift acceptance policy. One, it's a good governance practice, something that for an organization, the board agrees on. You should include the board in the discussion of that, make sure that the gifts that you are accepting make sense for your organization, and consider your audience. I think it should be for, your donors to let them know what you will and won't accept, your staff so they know as well. You don't end up with something that you didn't necessarily want or don't know how to get rid of. And then, you should have on here, it says who's accountable. Like Lauren said, is the policy being followed, and who's responsible for ensuring that is? I know some organizations, larger organizations that we work with, have a gift acceptance committee as part of their board. So that may be something to consider if you're getting a lot of these types of gifts. But I know from a tax perspective, this is something that the question is asked on the 990 about this policy. But, Lauren, you mentioned when we were talking earlier, having your legal counsel involved in drafting this isn't a bad idea.
Yeah, exactly. I think having legal counsel involved is a great idea, because you really want this policy to help mitigate potential future awkward situations. And a lot of times where we've seen organizations really benefit from having gift acceptance policies is when they're presented with an opportunity for a gift that is not something that aligns with what they want to accept, or there are restrictions on the gift that cause them some sort of undue burden or stress. For example, a requirement to potentially sell, or a request for them to sell an asset once received. And I've seen this and consulted on a lot of these situations with donor-advised funds, when maybe a donor wants to put an asset, portion of a business into a donor-advised fund, and potentially has an idea for where it could get sold one day. And so that type of, request or requirement, maybe an organization doesn't want to be put in a situation where they're influenced on how or when to sell, and that could be a part of the policy. So really it's to think through some of those scenarios and have a counsel connect with your organization on what risk you are willing to take and what kind of restrictions you do or don't want. If you don't want to be bound by something, then it shouldn't be in a gift acceptance policy. But if you don't want to get put in a situation, maybe document, and so that you can point to that policy so you're not worrying about donor relationships or donor issues when it comes to that sort of thing. So.
Exactly. So if you don't have one, consider that you might want one so that you don't end up with some complex gifts if that's not what you're looking for. Yeah.
And review it continuously, because the landscape changes in this area. So make sure it's being evaluated.
Absolutely. Another policy I think that, organizations may or may not have is an investment policy. If you're early into investing, you may not have an investment policy, but this is, again, good governance to have one in place, just because you don't know what you may get in terms of a complex investment. And is that, one, is it something you want to accept? But then two, how are you managing that and reviewing the investments? Does it fit within your investment policy? And I think things to consider when looking at your investment policy, and there's a lot of examples out there on the internet. There are also, people that can assist you with writing them, your investment managers. But, one thing to consider, and we'll talk about later throughout this presentation in terms of complex investments and those alternative investments, is there is a cost associated with holding those investments, and oftentimes additional filing requirements that come along with some of those investments. So, it is good to consider that when writing your investment policy, because, there are costs associated with holding some of those things that you may not want to take on. So we'll talk through that as we go through the presentation as well. There's also additional risks with some of these investments, and so that's something to consider while you're thinking about your investment and your gift acceptance policy. Is, do you want to take on the additional risks as well? I talked a little bit, and we'll continue to talk about informational risks with the alternative investments, and are you able to get the information you need to make management decisions about those investments, or to report them on your audited financial statements if you have those. There's the investment risk. You just don't often know exactly when you're going to be able to get the money back. There's some complex legal structures, volatility in those investments, so you may lose money, and you may have big windfalls as well. But do you need that money to sustain your operations? Then you may consider that's not a great investment. And there's oftentimes, like I said, we'll get into additional reporting requirements around that with the IRS for those investments. So a lot of things to consider when you're looking at these alternative investments and complex gifts. Looks like pulling question number 3.
All right. So the third out of 6 questions is, how many alternative investment funds do you currently have? A, greater than 50 funds. B, between 10 and 50 funds. C, fewer than 10 funds. Or D, none. And while you're responding, for those of you that would like a copy of today's slides, you can download them now from your console. We're also sending a follow-up email with the slides and a recording of the conference sessions next week. All right, here are the results.
All right. So it looks like, quite a split, but there's a number of you who have quite a few funds. And so I think this, is relevant information to consider or revisit in terms of the risks and rewards of holding these investments. So we'll talk a little bit about management's responsibility with regards to alternative investments. We as auditors are looking at this, but it's ultimately management's responsibility to understand the existence and the valuation. As I said, some of these assets are hard to pin down because they don't necessarily have a piece of paper that goes along with them. So making sure that you're not getting into something that is a scam, first of all, and we'll talk a little bit about that on the next slide in terms of the due diligence, but also having, processes to continually assess the value of these assets or complex investments and gifts. It is one thing when you first get it, you have the fair value, or you may have an appraisal or some sort of document that's provided by the donor to tell you what the value is, but then there's additional ongoing monitoring and assessing of, the controls around how you're doing that to ensure that you understand the value at any reporting date. Oftentimes it's good to consider that during your initial due diligence and understanding what you're going to get from a donor ongoing. If you're going to hold that asset and if they have any responsibility in providing you that information, or if that's going to be on you. So those are good conversations to have during the gift acceptance process, just to ensure that if it's a privately held stock, maybe it's a closely held business that they're involved with, are you going to get information from the donor or is that going to be something that you need to get? And then, are there strings attached? Oftentimes the donor could ask you to hold it. Maybe it's restricted. Are they asking you to sell it back to a certain individual? And maybe that's something that you want to consider as risky and may impact your tax exempt status. So things to consider when you are accepting these types of gifts. And again, as I was talking, your initial due diligence, understanding what you're getting, and that may be, actually going and seeing it. Like I said, the existence, sometimes you can do that, sometimes you can't. With property, you may want to go and see if it's something that you really want. Independent appraisals, that's something that you really want to have. If you get a gift that's hard to value, have a third party appraise it. Talk to the investment firm that's giving this to you. Talk to the donor. Does it fit within your strategy? And then document all of the work that you did. Make sure that you understand what you did to see it, to initially value it, how it was initially valued. That's something that you want to keep in the documentation surrounding the gift, so that you have that to look back on if needed in the future.
And we do have a couple questions here that I wanted to highlight, connected to this due diligence. The first one is whether this would apply for just when you get a gift of an alternative investment or owning any alternative investments. And I just wanted to get your thoughts on this, because a lot of organizations are using alternative investments as a diversification strategy in their portfolio. So is there a difference between the two processes?
Not really, would be my answer. I think that you'd want to do it's going to be management's responsibility to understand the existence and the valuation of the assets, whether they're donated to you or you invest in them initially. I think you want to, with this initial due diligence, you want to do the same type of due diligence, whether it's an asset that's being given to you or something that you're investing in. I think there's another question about utilizing an OCIO and the responsibilities of this. So if it is part of your diversification strategy, and you're using, an outsourced firm to manage your investments, typically they're going to have a process to do some of this initial due diligence. But you would want to sit down with them and really understand, what are they taking responsibility for in that? And what are they providing to you? Also, when you're looking at the follow-up valuation, understanding, typically you're going to rely on that outsourced provider to do most of the work surrounding the valuation, but you're going to need to understand their valuation methodology and that you agree with that, and that you wouldn't make any changes to that. So more of a monitoring situation when you have that outsourced function, making sure that you're holding them accountable for doing what they say they're doing, and that you understand what it is that they're doing to get to that valuation of those investments.
Yeah, and furthermore, on the tax side, I would add to that a lot of times, we're talking to our clients saying, hey, if you have any alternative investments or foreign domiciled investments, are you getting K1s? What types of funds are you investing in? And they might just shrug their shoulders and say, our investment firm's managing this. And their goals are going to be different than your goals as an organization. So as an organization, you're going to be responsible for the compliance connected to those funds, whether it's reporting taxable income or state and local tax liabilities, which we'll go into later. That's going to fall on you as an organization. So you should understand the impacts of the strategy. Yes, while they're concerned with, your outsourced CIO might be concerned with maximizing your investments and kind of the value, you would have to understand the impact that's coming to you as an organization in terms of what is going to get reported on your financials and your tax filings and the compliance in that area. So Liz is exactly correct, and there's coordination and understanding there.
Correct. All right, polling question 4 of 6. We're just knocking these out.
Yeah. So the fourth question is, from an audit perspective, what risk level are alternative investments typically considered? And then your options: A, high risk; B, moderate risk; C, low risk; or D, not risky.
Good auditor question, but I think just the fact that we're having this whole session on this probably tells you a little bit about the answer.
All right, I'm going to close this out here in a few seconds. Here you go.
Yep. High risk typically is what your auditor is going to call alternative investments, just because of the so many unobservable inputs that go into the valuation. There may be different circumstances surrounding what you're invested in that might bring it to moderate or low risk. Typically, that would just be if you had a very immaterial balance, maybe one investment that just didn't really wasn't a very big part of your investment portfolio. It may be a low risk, but typically these types of investments are high risk in terms of from an audit perspective, just getting that valuation right. All right, Lauren.
All right. Great. So now we move along to the tax side a little bit, take a little break to talk about some of the responsibilities of you as an organization once you receive that contribution of a complex asset. And the first slide just is a really quick refresher about the charitable contribution substantiation. So as a 501c3 organization, a public charity or private foundation, you're required, if your donor is going to take a charitable deduction, you're required to provide them with at any time, you're required to provide a donor with a charitable contribution acknowledgement for any contribution over $250. I am just reminding, and including that there because we have seen oftentimes when, if you're dealing with a private foundation of a family or of a donor, that donor might transfer a good amount of money to that foundation, and something that could get lost in the shuffle is that formality of that charitable acknowledgement that goes from that foundation to that donor. Even though it might be signed by the same person, the person running the foundation might be the person giving a deduction, that charitable acknowledgement needs to be in place. Now, when you have one that's cash, it's pretty easy to document what was received. All acknowledgments must provide the name of the organization and the amount of the cash contribution, as well as a statement that no goods or services were provided by the organization, if that is the case, if there was no quid pro quo benefit. When it comes to the valuation or providing information about non-cash contributions, what's required and what you should do as a recipient organization is only acknowledge what asset or assets you received and not put any sort of information about the projected fair market value, the amount that the assets are worth. Even if you're getting publicly traded securities, providing the value of those publicly traded securities is not something that you should be providing to that donor. It should just be a description of the assets that are received. So it's just really important to document that, because we oftentimes will have donors that might provide with a donation a valuation, and oftentimes you're required to provide an appraisal or something to that effect. But that charitable acknowledgement should not include anything connected to what the value of a non-cash item is. The donor also has to retain their documentation that shows the transfer of assets or funds out of their account to the nonprofit account, but from the nonprofit organization's perspective, they have to provide that acknowledgement. We have seen, even when there is documented proof of that transfer, without that substantiation, we have seen donors get denied charitable deductions because they don't have that charitable acknowledgement that states no goods or services were received in exchange for that. And it's oftentimes a pretty black or white issue in an IRS audit of an individual and their charitable donations. So it's just something that's just low-hanging fruit to just make sure that you're doing to maintain those donor relationships.
There's a couple of questions on that, Lauren, that I thought we could do while we're on the topic. The first one is the written acknowledgement due to the company or the name on the check, or can it be assigned to a majority owner of the company who directed the company to make the donation on his or her behalf?
As a charitable organization, I would provide the acknowledgement to where the money is coming from. So that acknowledgement should be where that check is coming from, not the person who's directing those funds, because there could be a potential issue there with improper deduction. So, yes, you might want to clarify in a case where the check might say something different than the individual or the donor's letter or the grant letter. You'd want to clarify where that deduction is coming from, but it generally should match to the place that the cash came out of. So if you're getting as an organization directed to give an acknowledgement to someone different, there could be a potential issue there. It's not your responsibility to audit that, but it's just I would say use a reasonable methodology for determining that. And that could be something that's included in your gift acceptance policy as well. That's something that's a great thing to document and point to if you are getting a lot of requests that are inconsistent there. I also saw there's a comment about in-kind rent. Something that is important from a charitable deduction perspective is that donated facilities and donated services are not items that a donor can take a charitable deduction for. So if you have somebody that's allowing use of office space or they're providing professional services, those are items that are definitely valued and included from a audit perspective, and it's reportable as value to your organization, but it's not something that a donor can take a charitable or should take a charitable deduction for. The reason being is that there is essentially no basis for that. So there's no basis for that rent or those donated services. The IRS doesn't allow you to take a deduction of in-kind rent, facilities, or services provided to a charitable organization. All right, so jumping along to the next one, I know there might be some other questions, so we can answer those as well in a few minutes. But the donors, this just provides a little bit of perspective of what's required from that donor's perspective. So when a donor gives cash, it's pretty straightforward. They need to have bank records to receive payroll deduction. We kind of talked about that, as well as anything over $250 must have that contemporaneous written acknowledgement. It says no later than January 31st of the following year, but generally it's okay to get that documentation before their tax return is filed and submitted, whether that's April 15th or October 15th. That would be considered contemporaneous, but really January 31st is the best practice for providing that acknowledgement to a donor and that donor receiving that acknowledgement. But up until the filing date of their return is okay as well. For non-cash contributions, the donor, if it's less than $50, they need to have a receipt. For anything that's more than $250, but not more than $500, they need to have that contemporaneous written acknowledgement from the organization that they contribute to. So less than $250, they don't need to have that quid pro quo statement that no goods or services were received, but up to $250 to $500, they need that. What's kind of a more confusing area is when a donor gives a non-cash contribution of between $500 and $5,000, they're required to have a signed 8283 attached to their tax return. That signed 8283 is given to the organization and signed by that organization, that organization received non-cash contributions that are valued up to $5,000. So as a nonprofit organization, you might receive 8283s from donors, and those essentially compare what you receive to what the donor is taking on their charitable return. So if you get those, it's important to review them and to sign them and to send them back to the donor. Again, this should be a process that's included in your gift acknowledgement policy. If it's a charitable deduction that the donor is claiming a deduction for over $5,000, that 8283 should have an appraisal attached to it. And that appraisal helps to substantiate their charitable deduction when they're taking a non-cash contribution deduction of over $5,000. So we'll see that a lot of times, and this would be not publicly traded securities. Those are exempted. Those are just the complex assets. So if they're giving you inventory, if they're giving your organization real estate, if they're giving your organization alternative investments or a part of a business, that 8283, and they're taking a charitable deduction for it, that 8283 needs to be signed by your organization and should have that appraisal behind it. It's not your responsibility to audit that and to make sure that appraisal is right. That's their responsibility to defend that and to have that appraisal accessible to them. The next slide here just kind of highlights how complicated the charitable deduction rules are when it comes to what that donor then can take as a deduction. So a lot of times we say, and this is nothing to memorize, this is always changing depending on, the way that tax, reform is going or tax law is going. But it just highlights that if a donor is asking you to provide them with how much their deduction should be for anything besides cash, the reason you don't do it is because of this schedule. Because a lot of times the type of asset, the length that the donor has held it, whether it's a short-term or long-term, whether it's a capital asset or personal property, ordinary income property, et cetera, that will determine what their deduction is. And the calculation can be complex because a singular asset could have a variety of type of assets within it. So if you're receiving a charitable contribution of business property, like a partnership interest, that partnership interest isn't just valued as a capital asset. It also has elements of ordinary income within it. And so that donor's charitable deduction is going to be impacted by the types of the kind of assets that are within it. And so I won't get too into this because this gets really deep into the tax area, but it's just highlighting why it's not necessary for a nonprofit organization to opine upon it and how complex these rules can be for that donor, and why you oftentimes see on the websites of donor-advised funds, organizations, or charitable community foundations to consult with a tax advisor on the gift of your asset and the deductibility of that gift. So now that that's kind of made everyone's head spin, we'll talk a little bit about when you do get that asset, how is it recorded on your books? What do you do? Do you use that donor's appraisal? Do you ask the donor what it should be? Liz will talk a little bit about recording the value of that complex asset on your books.
Yeah, this is where, it becomes a good idea to make sure that in your gift acceptance policy, you have an understanding of what it is you're getting, so that you know what you may need to get and can kind of be prepared for these before you are trying to record them. I think that you want to understand what the fair value is, and that's what you're going to record it at the time of the gift. But, depending on the type of asset, that might be easily ascertained, or it may not be. So most often, I think in complex gift situations, what we see is an appraisal, whether it be personal property or real estate. There's oftentimes an appraisal done. Somebody will do an appraisal of almost anything, so that you have a third-party valuation of the asset. It's not based on what the donor tells you. It's based on a third party actually looking at that information. If it is something like an alternative investment, oftentimes there's audited financial statements associated with that, so you can look at those. You can look at K1s, capital statements, things like that, that the donor may have to have the valuation there. Oftentimes privately held stock, you may have to get 409A valuations. So there's a lot of different underlying data that you can get for various types of gifts to try to figure out what that fair value is. But this is why you want to have that gift acceptance policy and thinking about what you're going to ask a donor for when you receive that type of gift. So if you have that in the policy, like, hey, we will accept this type of gift if we get an appraisal, it's nice to have that thought through before you're getting the gift and you really want to accept it, but you don't know how to record it. And it's the year end and you're trying to get everything closed. So those are good things to think through in that initial policy when you're going through that process. I think the next
Okay, well, I can chat a little bit about this. I referenced this a little bit already, but if the donor is taking a charitable deduction of a complex asset, starting point is going to be that fair market value that they establish of that asset. If the property has decreased in value from the donor's original basis, which is what they purchased it for, then their deduction is limited to that basis. So if the value is less than their basis, it's limited to that fair market value, If the property increases in value, there could be potential adjustments depending on who they're contributing to, right? If it's a private foundation or a public charity. But this would be for a public charity. There could be just some adjustments to that value if there's ordinary income property, or if there's capital gain property, there could be some shifts in what that deduction looks like if you're a private operating foundation, a public charity, or a private foundation. Inventory has its own special set of rules. So if you're an organization that receives food inventory from a business that does, produces food in some sense, and they have their own special set of rules. So this is all, it can be a little bit complicated there. I did want to show what an 8283 looks like for you all to just see a little bit. It seems straightforward, but it could be actually pretty confusing for them once you look into the nitty gritty and once you actually see the information for a charitable donation on there. But again, this is attached to the return of an individual, partnership, or corporation that is claiming a deduction of a non-cash contribution over $500. So that's when you would see this. A lot of our clients say, I got a non-cash contribution from a business and I didn't get an 8283. And sometimes that could be because maybe they're not taking it as a charitable contribution. Maybe they're taking it as a ordinary business expense. This would be more in like the inventory, or, if they're contributing to a gala or something. This isn't going to be a donor advised fund complex type of donation. But for the most part, when the main purpose of giving is because of that charitable deduction and it's a non-cash item, you'll see this item here. And what do? Sign it and just note that you've received that item and make sure that you have a process in place for who's signing the 8283. Make sure it's an appropriate person and not, somebody that's working at the front desk of a business. If you are an organization like a Goodwill or something, a lot of times the person working at the desk might get an 8283. A person working at the front might get this 8283 if a donor brings in something of value, and they might not know what to do with it. So make sure that there's a communicated process. Again, this is a foundation conference, so this is probably not going to happen in that setting, but just note that there should be a process in place of how these are signed and evaluated. The next section we're going to go on to is what to do once you get that asset. What are your options? But before we get on there, we did have a question that came through from the perspective of foundation, where someone says, our foundation, when we give our grants out, we don't get written acknowledgments, and that is okay. If you are a foundation giving to other public charities, you do not need to obtain a charitable written acknowledgement that meets those charitable acknowledgement requirements, that has the name, address, and no goods or services were received. That's only when you have an individual or business taking a charitable deduction under Internal Revenue Code 170. That's much different from foundations that are giving out grants as part of their charitable purpose and mission. So that is not necessary. Signed grant agreements are great. If you're giving to a qualified 501c3 public charity, technically don't even need a written grant agreement. I wouldn't recommend that. That's really a best practice, but there's no requirement for what substantiation is required for you to report that as a distribution for charitable purposes, as long as you're giving to a qualifying 501c3 public charity. So that's probably for a different session, but that's just to note in case that the concepts are getting confused with you as a grant-making organization versus you receiving charitable deductions from donors.
Yeah, and from an audit perspective, your auditors are going to love to see that you have those signed grant agreements, just as part of your control process, ensuring that you have documentation of what you're giving and whom you're giving it to. So it's a good practice. Like Lauren said, they're not required to send you a written acknowledgement, but you having that documentation of who you sent the money to and a signed agreement from an audit perspective is also perfect.
All right. So the next section talks a little bit about the options that you have with those complex assets once you receive them. Remember, those complex assets could be alternative investments, it could be Bitcoin, it could be real estate, it could be insurance policies. The first kind of option that, and much of this could be determined by your gift acceptance policy, and many of our donor-advised funds and community foundations have a policy, especially if they receive non-cash items to a DAF, that they immediately dispose of that non-cash item. One thing to consider if you're immediately disposing of that item is there could be potential taxable gains for a non-profit organization, depending on the type. So private foundations will need to account for gain on the sale of property, and that gain is going to be generally at the rate of 1.39%, although some could be potentially unrelated business income. But one thing that's complex is that you'd have to account in all cases for the donor's basis when calculating the taxable gain for the sale of the property. So if you're a private foundation and you receive donated property and you sell it, then you have to calculate gain based on that donor's basis. So even if it was an appreciated asset, something that they bought for $1,000 that they contributed worth $10,000, and you immediately sell it, you've got that $9,000 of gain to account for at your 1.39% rate, but still something to consider. So you might see kind of a difference in book gain to tax gain when you have those types of sales. If you're a public charity or a donor-advised fund, you should consider if the property or asset is debt financed or producing UBI. If it's an alternative investment that produces UBI, there could be some component of that gain that's taxable. Otherwise, generally, realized gains are not taxable to public charities. If the property is sold within 3 years, then an organization has to file with the IRS a Form 8282. And that form is kind of the sister form to the 8283, and it reports to the IRS what the sales price of that item is. And in theory, it allows the IRS to match the appraised fair market value to, in theory, the actual fair market value of an asset that's sold. And so, on the 990, there is a question: did a donor require you to hold property for a certain amount of time before selling it? It's getting to whether a donor makes you hold an asset for a couple of years so that they don't have this 8282 that's filed by the selling organization to filing that form with the IRS so that they can reconcile those two amounts. Doesn't necessarily lead to an automatic adjustment. I've heard situations in both cases where it has led to adjustments for that donor and their fair market value, and situations where it has not. So then the next potential option is granting out the asset. And this, it's something that we don't see as much. There is also using the asset for charitable purposes. That's something that we kind of refer to on the other disposing of the asset. You can use it for a charitable purpose, and that's something you can do as well. But granting out the asset for foundations, that's something that could be done as well. You can grant the asset to another 501c3 entity. The fair market value will count as the qualifying distribution, and you don't have to account for the gain on your 990PF. So that's a consideration there. That could be beneficial to your organization, that you wouldn't have to report that gain. Although a lot of our clients are not too concerned about that 1.39%. But, if there's UBI or potential UBI issues, then it could be a benefit as well to be able to grant that asset out to another 501c3 entity. Somebody asked, is fair value the same as fair market value? Yes, fair value I think is more of a GAAP terminology. Fair market value is what we use more on the tax side of things. All right, so the next option is what happens when you decide to keep the asset. So maybe you don't sell, maybe you don't distribute it, maybe you want to keep the asset for a variety of reasons. You think it'll be good for your portfolio, you're required to, the donor needs you to keep it, whatever it might be, you keep that asset. I think the first thing that we're going to start with is, before we dive into kind of the tax considerations for keeping a complex asset, talk a little bit about the monitoring that you do on an ongoing basis once you have that asset.
Absolutely. Yeah, and this is where, these controls that we're talking about, going back to the question on, if you decide to invest in some of these assets, whether it's donated or whether you're investing in it, these are kind of the controls that you want to have in place for these types of complex gifts and investments on a go-forward basis, because you want to continue to do ongoing monitoring, and whether that's, it says conduct regular meetings, whether that's with your investment committee or with with a donor, if you still have that relationship where the asset is sitting potentially with multiple, you're part owner of a bigger asset, which often happens. You're donated a piece of a business. You want to continue to have those meetings regularly, understanding what's happening with that asset or investment, and if there's any changes that might change the value or how you report it. So you want to make sure you're getting that. We often we'll tell our clients, you should be looking at this at a minimum quarterly, because that's typically how the reporting is done on some of these investments. You want to understand if there's, changes in the valuation or performance of the investment. And then annually, you want to get, the audited financial statements if they exist, SOC reports, which is the system operating controls. So if they have a SOC report, you want to understand that. K1s as well. You want to be reviewing those things, and going back to, if you have an outsourced firm providing your investment monitoring, you want to understand that they're obtaining these things on a regular basis and reviewing them and providing you an update on any changes that you should be aware of. So that's something that they can do for you, but you do want to make sure you're getting that reporting back so that you understand where your investment is at any point in time. And talking about appraisals, this is something, you get a gift of maybe real estate, it's got an appraisal, but what's your policy on redoing the appraisal? Oftentimes I see organizations that had property donated 10 years ago and they haven't had it reappraised, the value is likely changed significantly in that time. And so, you want to have a policy surrounding that. Maybe it doesn't make sense to do it every year because it can be expensive to do those types of things. But what's your policy depending on the asset? Does it make sense to do it every 3 years, or is 5 years okay? Or do you do it every year because the valuation can change so significantly? So you want to have an understanding of what makes sense and have a policy in place so that when your auditor asks, you say, well, we didn't do the appraisal this year because, we're following our policy. There's other, things that you might have to do an impairment analysis. You've got something recorded at cost, and, it might be some intangible or IP, and you need to know whether or not it's impaired. So understanding how you're performing that analysis, what goes into that, again, having a policy in place for what triggers that analysis. You should be looking at that at least annually to make sure that the asset isn't impaired. But you want to have a policy around that as well. You also want to have controls around the financial reporting for these assets. Oftentimes, you're required to do the GAAP audit. So, you will have to report GAAP financial statements, but there's also probably reasons to have those meetings. The board wants to know, oftentimes, especially because the complex gifts come with volatility or potential risk. You want to be reporting on those regularly. And obtaining information for, like I said, if your outsourced OCIO is doing that, having a cadence for that, and when you're getting those reports, like I said, quarterly is typically the minimum. Potentially monthly, you want to be seeing your performance reports to know how that asset is doing. So you want to have policies in place surrounding this before you get into these investments so that you can ensure that you're doing your due diligence and adequately monitoring these investments or assets on an ongoing basis so that you understand the valuation, because it can change significantly from a financial reporting perspective from month to month. From wearing my auditor hat, definitely we are going to be performing risk assessments over these types of assets, deciding where we want to spend the majority of our time looking into these complex assets and which ones. So some of the things we consider that you'll want to consider in your risk assessment is the materiality of the investment. So in terms of the relation to your entire investment portfolio, how big a part of that portfolio is this specific investment? Because, if it's not material, you may not want to spend a lot of time on it. Again, there's costs associated with these types of investments and complex assets. So like I said, the appraisal, if it's not that big of a part of your portfolio and a significant change in valuation wouldn't be, that big of a change for your entire investment portfolio, you may not want to look at it every year or even every other year. So you want to consider that. Also, how much do you want to report? What degree of transparency do you get from the investment manager or from, the private company? So there's risks if you really don't get anything. That may not be something that you want to continue to invest in. So there's a lot of things to consider when looking at the risks of investments. But these are a few of the things that, I'm sure your auditors are looking at when they're considering what they really want to hone in and test. We're looking, again, from an audit perspective for alternative investments, and this is very similar. There's a slide here on the complex investments as well. But we're gonna look at these controls that you have in place. We're gonna, like I said, we're gonna ask if you have a policy on how often you do these things. When are you monitoring? So we're gonna look at the control structure that you've set up in order to understand if you're adequately monitoring these investments. We're going to do confirmations when we can with those third-party investment advisors, with potentially with the closely held businesses. Oftentimes we can't get a lot of information for confirmations through we're looking at existence, but oftentimes we don't get a lot from the investments. And that's why there's so many unobservable inputs, where we're really looking at your valuation methodology and what information you're obtaining. We're looking at audited financial statements. That's kind of the best thing that we can get. A lot of the hedge funds and fund to funds will have audited financial statements that we'll look at, and we'll reconcile your portion of that investment back to those audited financial statements to ensure that it reconciles and that there's no adjustments that need to be made. Oftentimes the audited financial statements aren't on the same period as your reporting period. So if you're a June 30th year end and the audited financial statements are December, we may have to roll back that and do some reasonableness analysis to see if the valuation makes sense in that 6-month change. And then, as I discussed before, we're looking at financial statement disclosures. There's a lot of disclosures for alternative investments. They want to know what are those unobservable inputs, and what level are these? Level 3? Are these valued at net asset value? And then your auditor is going to ask you to make management representations on all of those things that you disclosed in the financial statements. You still have to disclose if there's additional capital calls that you need to make, and those types of things that are required by the accounting standards. And so we're going to ask you to make representations to those. And it's very similar audit steps that we perform for other complex assets. But oftentimes, this may be where management's impairment analysis comes in, because there isn't a fair value. An asset that's not held at fair value, you need to evaluate for impairment annually to make sure that value that's on the books still makes sense. So,
Liz, I have a couple questions that have come through. So one person asked, is there any current or updated guidance on cryptocurrency and how to value that?
Yeah, so crypto is an interesting one that kind of, since its inception, became something that GAAP wasn't very clear on, because it didn't exist when they first put it out there. And it was said that cryptocurrency is not a financial asset. So the original guidance that was kind of followed was as an intangible asset. So you were putting if you were donated cryptocurrency, it went on your books at the fair value at the time of the donation, but then it was held at that and evaluated for impairment, like an intangible asset would be. There was a standard issued, an accounting standards update issued, the very last one of 2023, I think, that said, that going forward, you should value cryptocurrency that's held as an investment at fair value. I think the thought behind that, was that there is a market out there. I mean, there are trading companies that you can sell this to. You can go out and look at a value on several different platforms for cryptocurrency and the various types of tokens. So it's I believe the standard, you can early adopt, but it is effective for, I think, fiscal years ending 2025. So 12/31/2025. So not yet, but I have seen most people early adopting this if they get cryptocurrency, because the values change so much, and it makes more sense to just hold it at fair value. So that is a change in how it's valued under GAAP.
Yeah, and I do want to say on the tax side, it's considered capital asset. So it's not considered a publicly traded security. So the way that you would handle it on the tax side is like you would handle any other type of property. And so it doesn't make it very advantageous to contribute crypto to like a private foundation where you've got that kind of limitation on basis if it's not publicly traded. There's also another question regarding what happens when you have an organization that internally doesn't really understand alternative investments or know how to value them, and they just say, well, I'm not going to do it, or I'm just going to take, whatever the fund tells me. Like, what is their responsibility to value, and what do you do as an auditor in that situation where the organization just kind of doesn't know how to value these alternative investments?
Yeah, I mean, I think that's a control issue from an auditor's perspective. You can't just rely. Obviously, you hire if you hire an expert to manage your investments, you're relying on them. But it's kind of the same thing as hiring, an auditor. We can't ultimately be your control. So obviously, we're going to look at things and we're going to try to give you our best analysis. But if you don't understand, you probably shouldn't be in the investment. So from our perspective as an auditor, we would say, that's great that you got the valuation from the third party. They should know what they're doing, but you need to understand how they got to that and have some accountability for and responsibility for understanding that value is right. So I think that we would say is you probably have a control deficiency there in terms of monitoring your investments, because if you don't understand what you're invested in and you're just relying on somebody telling you that that's what it's worth, you can't really be certain that that's a good investment. So we would probably suggest they get either out of the investments that they don't understand or get someone who understands them internally to the organization that really can review what's being provided by that third party.
That's great. And it does factor in, if you're a private foundation, to your private foundation reporting, your distributions requirements. We'll get into all of that in a second. So there is it's important that you understand the methodology for the values that you're reporting on your books. Which I guess we are there right now. So before we spend the last 15 or so minutes of this call diving into the tax issues that are connected to keeping a complex investment or complex asset, we have a polling question.
All right. So the fifth polling question is, do you file a 990T for UBI from alternatives? A, we file one every year. B, we probably should. Or C, never.
And I guess if everyone clicks C, never, then probably the last 10 slides are not really that relevant. But, I know that we have a lot of organizations. I think most of our complex foundations and community foundations do file 990Ts. Most of our organizations have a 990T for alternatives or other types of assets. So excited to see what everyone puts. All right, well, 31% of you might tune out for the last 5 minutes, but it's still very relevant because you never know when UBI comes up or when it can happen to you. So what we're going to talk about are the potential areas of exposure that come from having a complex investment. This is really just a high-level checklist of the things that I would talk about with the client when they are considering, alternative investments, or when they're considering a complex donation, like they're receiving a donation of some sort of fund or some sort of business interest. We would essentially walk through these potential issues as a starting point to look at that. And The rules are a little different, but do overlap in some areas for private foundations and donor-advised funds. Public charities might have some, like so donor-advised funds, when I say a donor-advised fund, that is a fund within a bigger public charity, community foundation, or donor-advised fund. So that donor-advised fund is just that smaller fund that the donor has advisory privileges over. So the first one I will talk a little bit about is excess business holdings. This is something that a private foundation and a donor-advised fund would have to consider if they received a donation of a business interest or of a alternative investment. So essentially, a foundation, and it says foundation, so I don't have to jump back and forth. I'm just going to say a foundation here, but you could say donor-advised fund as well. But a foundation's holding of certain business interests combined with those of disqualified persons, meaning their board members, their foundation managers, their funders, cannot exceed 20%, potentially 35% in situations where there is no control. So that's something that has to be considered when you're receiving a contribution of a business asset. This would apply to corporations. It would apply to partnerships. It would apply to LLCs. So any sort of business interest that's an operating business to a private foundation or to a donor-advised fund itself. You'd have to look at essentially what the combined investment in that business is between the donor as well as the fund. And so how does that work out? So how that works out is that there are some exceptions to that excess business holding, exceptions being like some, places that we can expand and look at this a little bit more. So initially, the foundation can hold up to 2% of a business interest without factoring in the disqualified person's ownership. So when we see an organization receiving a business interest or an alternative investment, our first question is, how much is that organization getting? If it's below 2%, we don't have to consider excess business holdings. If it's above 2%, then we have to look to see, is there any other interest with, does the donor who's giving that fund retain any interest in that business? Does anyone else on the organization's board or any other foundation manager have any investment in that same interest? And if so, might that exceed up to 35% if there's no control, but 20% is kind of the base amount. That's the safe amount. So if it's at below 20% combined, you're okay. You can jump up to 30%. Another exception and something that you can look at is that business enterprise, is it actually a operating business enterprise? If so, could it be considered functionally related to the operations of that foundation? If not, is it mostly passive in terms of the income that it generates? So is it really just an investment vehicle that's like a holding company of other types of investments? So those are the things that you would look at when you do an excess business holding analysis, but that would need to be analyzed for both private foundations and donor-advised funds. The next thing that we would look at with a private foundation receiving an alternative investment or business interest is self-dealing. So self-dealing itself self-dealing overall for a private foundation would be any sort of business transaction that occurs with a significant donor, with a founder of an organization, with an insider or disqualified person of that organization. That can take a bunch of different forms. It can be a sale, exchange, lease of property, loans, extensions of credit. Things that it's not would be, if the donor provides a donation to the private foundation, donates, facilities, donates properties, donates services, those would not be self-dealing. So when might you have self-dealing when it comes to a business interest or a complex asset that's donated to a private foundation? It could be maybe if there's debt within that asset. So if accepting that donation, there's some component of debt connected to that asset. So you're receiving a home, but there is a mortgage on that home, a donated property, but there's a mortgage on that property. Taking that property subject to debt could be considered self-dealing and impermissible. and so that's something to consider when you're getting those donations. Additionally, oftentimes we'll see that somebody might want to donate and then buy back at some point. There might want to be a consideration, well, we want to donate this today, we want to buy it back. We recently had a situation where a donor wanted to donate certain property, but then have use of that property in the future for, trips or horses or hunting, whatever it might be, and that could be considered self-dealing in a private foundation setting. That would be considered self-dealing in a private foundation setting. So there's very little ability in a private foundation for there to be kind of use or impermissible benefits from an asset that becomes charitable once it's donated in. Those are things to kind of ask. Those are the questions that we ask when there might be a complex asset coming into a foundation. It also applies in certain situations, but a little bit different. So donor-advised funds don't have self-dealing to the same extent that a private foundation does, but it does have certain protections that make any sort of donor, or donor advisor to a donor-advised fund, any sort of benefit to that donor, a potential issue. And one is called an excess benefit. So essentially, you cannot provide grant loans or compensation from a donor-advised fund to a disqualified person. And that, I've seen it in certain situations. It's technically not self-dealing. So we have been brought into situations where donor wanted to donate a complex business to a donor-advised fund, and then that donor-advised fund was going to sell the business back to someone related to that donor. Technically, that sale is, I guess, okay if it's that. I wouldn't really recommend it. There's a lot of other issues, but it's not prohibited like it would be in a private foundation setting. But that sale was not a sale for cash, but a sale where there was debt. And that could be considered an excess benefit under the donor-advised fund rules. Additionally, donor-advised funds have to only distribute, they can only distribute to qualifying organizations, and there's also there cannot be prohibited benefits to any donor advisors. So when you're receiving that complex gift, you just want to make sure that there's no distribution that could result in a donor receiving an indirect or incidental benefit from that donation besides the charitable deduction that they would get from that donation. So self-dealing is something to consider if you're looking at receiving a complex asset from a donor as a private foundation or a donor-advised fund. Something to call back to what Liz mentioned about valuing the assets is that when you do have those alternative investments or other types of complex assets, they do need to be valued every year for reporting on the 990-PF, and your annual distributable amount, if you're a private foundation, which is 5% essentially of the value, fair market value of your assets, is calculated based on the fair market value. So not the GAAP value. There are some provisions where you can keep things at cost on your balance sheet from a GAAP perspective, but it's truly the fair market value of those assets. So you do need to have a process in place to value them annually. There is an exception if you are receiving real estate. If you have real estate and you're a private foundation, you can get a qualified appraisal and you can value it and use that valuation for up to 5 years. So it's a good idea if there's ever a decline in the housing market, if that happens ever again, and you're a private foundation that has real property, to get a valuation that kind of shows that reduced value in that market, and you can keep that for up to 5 years. That just impacts what you have to distribute. Most of our foundations aren't really too concerned about this, but we do have a lot of foundations that are heavily invested in venture capital funds or other types of things, and they're not as liquid, and so this valuation really impacts their operations. All right, the next item to think through is the net investment excise tax. So you do have to account for any flow-through income as part of your net investment excise tax. So if you are invested in alternative investments that are partnerships, those K1s will provide important information to calculate your net investment income tax. So you do get to reduce it if any of your K1s do flow through UBI, which we'll talk about next. that flow-through characteristic of that UBI is also not, it's excluded from this 1.39%. You do pay, 21% if you're a corporation on that, but that would be excluded from that. That UBI would be excluded from your 1.39% investment excise tax, but you do have to account for that flow-through income when you're reporting that 1.39% excise tax. And that is really, as we're, in the last couple minutes, what we're going to talk about is that unrelated business income. And this is a consideration when you have alternative investments generally, or investments in a business that's structured as a partnership or a limited liability company. There is a flow-through characteristic that applies. Although it's an investment to you as a 501c3 organization, the IRS looks through that investment overall and says that the characteristic of the income that's produced within that partnership flows through to you, a nonprofit, as the partner in the characteristic that it's earned. So if that partnership is operating a trade or business, you do have to report that as unrelated business taxable income and pay tax liability on that. Similarly, if that investment has debt financed income within it, so if there's rental income or interest income that's debt financed, if you as an organization are using debt to purchase investments, that's also unrelated business income, but a lot of times we see it flowing through on a K-1 as well. So these are things to consider. You do have those flow-through characteristics of taxable income on those K-1s. To add to the complexity here, when we got tax reform a couple years ago, which is now, kind of coming up to its potential expiration for certain areas, but not this area, tax reform required that nonprofit organizations and tax-exempt organizations separate into different silos income from the different types of investments. So the loss from one business is oftentimes not able to offset income from another business. So fortunately, there are ways to combine any sort of alternative investments that meet certain thresholds together as qualifying partnership interests. But a lot of times, if you're investing in a different type of business, or if you have a more significant investment that doesn't rise to the level of rise to the level of an excess business holding, you could have UBI that is not, that some is earning income and some are earning losses, but you're not able to offset the two of those things. So calculating that silo is really important from that UBI perspective. And so that's something to consider. I think this is our final poll before we have the last couple minutes, so I'll just talk about a couple other different characteristics besides the qualifying interest. There are some slides on the KPIs that you can look through if it's applicable to you. Amy,
so this is the last. Yeah, this is the last one for the day, actually. Is each partnership a separate activity? A, yes. B, it depends. Or C, not sure.
Right. And as we're getting those final polls, UBI can be really complicated, and a lot of times you're beholden to a K-1 to figure out what is getting reported to you. And so oftentimes you can take what's on that K-1 as being true. If that K-1 does or doesn't establish UBI, you can, question it if there are things that seem inconsistent to you as a nonprofit organization. So that's something just to comment on there. Good job. It depends. Perfect. I'm not sure. It's probably because I'm going to skip over the next couple slides that go through the aggregation rules for an investment silo. But for your reference, you can take a look at that if you're wondering, what types of tests you'd look at for aggregating your qualifying partnership interests. Our nonprofit organizations often get letters or requests by their investment funds to ask if they want to put their UBI in blocker corporations. And so this is something that just would protect the nonprofit from reporting the characteristics of UBI on their return, but oftentimes it comes at a cost. So every time you're asked if you want to invest in a blocker corporation, you want to think about the cost benefit of such a corporation. It can simplify your tax compliance, but oftentimes the cost within the fund is going to be a greater cost to you. But if you're an organization that wants to simplify your filing, because it's not just UBI, as you'll see in the next couple slides, you have to consider state tax compliance. So oftentimes those K1s have UBI that's allocated to different states. So you might have reporting requirements that go across, 40 different states. If you have really complex investments that have UBI that's allocated, that's earned and reported in various states, you could have that reporting there. There's also, the process to consider if you're going to file in each of those states and the cost-benefit analysis there. If you have a blocker, the blocker is handling this. But if you don't have a blocker and you're invested directly in a partnership, you've got to consider these things yourself with your advisors. Additionally, if that organization, if your alternative investment or your partnership is undertaking foreign activities, that flows up to you as well, and you might have foreign reporting, which, while not complicated and not too risky, does come with penalties if that reporting is missed. So those are just some of the things to consider when it comes to keeping and maintaining those types of alternative investments and complex investments. And, if there's more areas you want us to dive into in the future, let us know in the survey, because there are so many things to consider, and any certain component of this could have been a whole entire course. So hopefully this helps a little bit as you make those decisions and check to see if your organization is meeting some of these best practices.
All right. Well, thank you. And the survey that Lauren mentioned is in your console in the handouts window, so feel free to submit your feedback there. And this does conclude the first day of the Moss Adams Private Foundation Conference. Thank you to our Moss Adams presenters, Wendy, Brett, Mike, Lauren, and Liz, and our guest speakers, Danica, Misty, Robin, Cheney, and Karl, for great discussions today. We have several interesting topics lined up for tomorrow, so please check your agenda to see what's to come. And we hope we'll see you tomorrow. Take care, everyone.